How's it going, investors? My name is Ari and welcome to my channel where we're going to be talking about both value and dividend investing today, as we always are. Now, there's no better time to get heavily invested into both value and dividend stocks than right now, with the stock market being in a total state of flux, which we're going to be covering in today's video, on top of covering a handful of stocks that meet the criteria of being both well capitalized with strong brand names to ultimately protect your portfolio against a recession. But before we dive in, if you could do me a huge favor here and tapping on that thumbs up button, it greatly helps me out in growing this channel. If you haven't already subscribed, I'd love to have you on the journey, so go ahead, tap on that subscribe button as well. Now, just before we dive in, let me go ahead and grab one cup of coffee. Okay, so can we just take a moment here to pause and recognize everything that went on last week is just ridiculous. And I bet you thought I wasn't going to be taking it in this direction, but no, I am very opinionated about what happened, because I find a lot of investors today to be highly emotional, overly emotional, investing with a get-rich-by-Tuesday trigger finger without a real process or investment strategy of any kind. Now, personally, my account took a massive hit, falling by about 14% within the past few weeks, now sitting at $94,368.27. So I want to break everything down. As of Monday of last week, Jamie Dimon, the CEO of JP Chase, was interviewed, and he shared that he foresaw a recession hitting within the next 6 to 9 months. Now, the market reacted out of fear and dropped before building itself back up, even though macro market conditions did not really change. Then come the release of the Producers Price Index, where we did in fact see better than expected results. The market didn't even really react, yet the Consumer Price Index then came out the very next day, and the inflationary report was hotter than expected, with inflation jumping up to 8.2% versus the expected 8.1%, and investors panicked. We saw a small sell-off, and hours thereafter that we saw then a mini rally take place. Guys, for the love of Swiss cheese, please do not fall for all of this emotional investing and make yourselves a legitimate strategy. Now, if you need, email me. We will create a strategy together, but do not fall victim to the short-lived market rallies, given the economic backdrop has not yet improved whatsoever. A matter of fact, it has only gotten worse. Now, looking ahead, the big day ahead of us is November 2nd, when the Federal Reserve is going to meet to actually render yet another interest rate hike decision, and we can in fact expect the Federal Reserve will be more aggressive given the strength of the labor market, and moreover, now that inflation didn't even budge in the slightest. With all of this set aside, I want to go ahead and just break down a handful of investments that you can add to your watch list, which in my personal opinion are recession-proof type of stocks, that if we are to actually hit a recession, they are well capitalized with strong brand names likely to prevail and overcome any trying times that are lurking ahead of us. So the very first stock that I actually want to stop and talk about today is Nike. That's ticker symbol NKE, which I'm sure you're all very familiar with, as it's a world leader when it comes to footwear and athletic apparel. Of course, Nike has been pained by high inflation and more recently growing recessionary fears, which has all shifted consumer spending habits, and it's why we've been witnessing this shoe dog on a decline regarding its stock share price, falling from $165 per share at the beginning of the year and now trading for only $89 per share. That's about a 45% decline, and heck, that's just about the price of a pair of Nikes in and of itself. And while its PE ratio is still rather high at 25.1, I am always going to go here first on a limb to say that it's Buffett's way of just paying that premium that may be worth it for a company that's going to deliver through on a ton of value. After all, we are talking about Nike here, a company with over $138 billion market capitalization. Now, what is rather interesting is when we take a look at website traffic right now, whereas we've been seeing an uptick, which is a possible positive sign moving into the holiday season, that Nike has a tremendous amount of momentum ready to come our way, not to mention all the hedge funds that have just been pouring millions of dollars into Nike. Now, last but not least, I'm certainly getting excited about analysts' expectations, as they are forecasting a ton of upside potential, as much as 23% worth of a target share price coming in at $110.33 per share. And of course, until it gets there, we can enjoy Nike's dividend coming in at 1.39% worth of a dividend yield. Next up, I want to jump into another industry leader, this time within the beverage space. We have Coca-Cola, ticker symbol KO. Again, another play where an introduction is not really necessary, given its 135-year history of refreshing the world with their iconic classic or any of their other 200 branded beverages, which has allowed Coca-Cola to really amass a market capitalization coming in at just over $238 billion. Now, investing into Coca-Cola is really only ever worth it if you can get into the investment at a solid buy-in price, which if it falls a tad more, it really may begin to look very attractive to a lot of investors. As of late, the share price has in fact been falling. As we can see, it recently fell from around $65 per share down to around $55 per share, which is only about 4.9% on the entire year. But for the safety it could deliver, should a deep recession hit, it's not such a terrible time to, at bare minimum, add Coca-Cola to your watch list. Although again, that PE ratio coming in at 25.1, you'd want it to drop a little bit more. However, Coca-Cola is one of these companies that really hardly ever gets hit too hard, very reliable. However, Coca-Cola's share price certainly has not stopped hedge funds from moving forward with an investment, given the necessity that these hedge funds find to now pad their portfolios, gearing up for a recession, and with analysts forecasting a bounce back for Coca-Cola's share price coming back up to $66.43 per share. It's about 18% worth of upside. On top of all of that, shareholders of Coca-Cola can certainly sit very comfortable with this beverage leader and await an economic turnaround while collecting on Coca-Cola's solid dividend coming in at 3.19%. And while jumping into the tech sector may seem a little riskier at this point in time, especially with all of this negative semiconductor news, depending on the actual tech investment itself, it may very well be worth a look into, say, a play like Apple or Microsoft right now. And because I personally am and will forever be an Apple guy, I want to go ahead and break down this $2.22 trillion tech behemoth. On the year, Apple has been plummeting by roughly 23% when it fell from $181 per share down to around a current share price of around $142 per share. But right now it has a PE ratio lower than both Nike and Coca-Cola. Pretty mind-blowing. It's at 22.9. Now mark my words, if Apple falls into the low 130s, I will be all over it, and I do not believe it will drop any lower than that. But fair value never bothered me, and the return on an investment into Apple could be huge with their product pipeline about to change, in my opinion, the entire world. From their AR headset due to come out in 2023 to what I'm most looking forward to, which is going to be the Apple Car, which will be a huge game changer in the EV space. Now, hedge funds tend to agree here. They are pouring millions upon millions of dollars into Apple over the last quarter. And once again, noteworthy website traffic as we head into the holiday season with the release of their new iPhone. This jazzes analysts up as well with optimism, and we can see a target share price coming up to $182.04 per share. Now, Apple just being, well, Apple, and likewise with Microsoft, talk about a moat of capitalization as well as strong brand names unlike any other. Both of these tech leaders fit the criteria of a recession-proof stock, in my opinion. And icing on the cake in terms of Apple is also the nice little dividend that they shell out to shareholders, and we're going to be able to collect on a 0.65% dividend yield. As for the last individual stock that I want to go over, is actually a toss-up between a play like a Walmart or a Target, or just heading in a healthcare investment direction, and I'm choosing to go in the latter with that healthcare direction, given the market conditions never negate the fact that one's health is of the utmost importance to them. So I want to go ahead and touch upon my favorite healthcare investment. That's Johnson & Johnson, ticker symbol J&J. Of course, with another 135-year rich history, it's been revolutionizing the entire healthcare industry, and of course has plenty of experience navigating through market turbulence. Now, Johnson & Johnson has been able to lead the industry not just in one of its segments, but all three, from pharmaceuticals to medical devices and consumer goods. But get this, in Q2, Johnson & Johnson reported over $24 billion worth of revenue, which was up over 3% on the year, while the entire S&P declined more than 20% this year. Johnson & Johnson was resilient and only declined by about 7% on the year, now only down by about 3% on the year, trading for $165 per share. And not to mention, with this $427 billion market capitalized industry leader, now only focused on pharmaceuticals and medical devices, after a decision to go ahead and spin off their consumer goods segment, I only believe that there's going to be plenty more upside, I mean serious upside to come from Johnson & Johnson, given their consumer goods segment was their least profitable. So sure, less diversity, but certainly more profitability, and in turn, more value then for shareholders, which then leads me to sharing that their PE ratio coming in at 23.6 while I'd like it to come down to at least 20, it's never really going to hit that low of, I think, a PE ratio. But you can also just see that it is in line with its competitors within the industry. Now, Johnson & Johnson is that industry leader amongst them all. As for hedge funds, they seem to be overlooking the price of Johnson & Johnson and preparing again for the worst, investing millions of dollars into Johnson & Johnson. Take a look at Fisher Asset Management leading the charge here with over $1 billion invested. Now, looking ahead, analysts are also led to believe that there's plenty more upside on the way, with a target share price coming in at $188.20 per share. That's about 13% worth of upside. And until Johnson & Johnson hits the heights of its target share price, shareholders will be able to collect on Johnson & Johnson's reliable dividend, coming in at a 2.69% dividend yield. Finally, investors, if none of those investments seem appealing to you or none of them are just suitable for your portfolio, please don't miss the opportunity to take advantage of a market that is allowing for stocks to trade at such discounted share prices. Now, I get just how intimidating investing can be, which is why I want to go ahead and conclude with suggesting that you find yourself a broad market index fund that covers essentially the entire stock market, one that you cannot go wrong with. Now, my personal fund of choice that I'm consistently dollar cost averaging into, regardless of the state of the market, is Vanguard's Total Stock Market Index Fund, ticker symbol VTI, which is over 4,000 stocks within it, split between small, mid, and large caps, with a balance of both growth and value investments. This is really the foundation of my portfolio and has yet to ever really disappoint or fail me as an investor. So at bare minimum, just dollar cost average your way into an index fund like this one, and there you have it, from Nike to Coca-Cola and Apple to Johnson & Johnson, the stocks that fit the recession-proof criteria of being well capitalized with stronger than ever brand names that have stood the test of time and will likely just make it through whatever the next recession has in store for us should a recession hit. Now, please note that this video is not investment advice. I am not a financial advisor, so if you want to make an investment into any of these stocks, just do your own due diligence. But you can in fact do me a favor here in tapping on that thumbs up button, and moreover subscribing to the channel. I'd love to have you on the journey with me. Now, of course, investors, I will see you all in the next video.